Hey, thank you, Kirsten. I want to thank everybody for logging in today and participating in our event. And I'd like to thank our sponsors, especially the OISTA Corporation, the Sovereign Council of Hawaiian Homesteads Association, and Clearinghouse CDFI, along with the Native CDFI Network. NCN is a membership organization, and as we go through the year of 2022, there's going to be certain presentations that we do make, and we're going to be presenting a white paper. So the white paper is only available to members, current members. And so I want to bring attention to our membership page, Kirsten. In our membership page there, it'll state the benefits. If you go to our website, NCN or nativecdfi.org or .net, you'll see our membership page. And it talks about a network member, affiliate member. And if you could click on the members up at the top there, Kirsten, and pull up the annual member dues. There you go, just apply, there you go, and hit apply, there you go. And this is a list of our membership levels, and so if you are a current member in any of these levels, you'll receive a copy of our white paper from the Native CDFI Network and Pilar Thomas present after the event is over. Give us a couple days, but if you're a current member, you'll receive it. If you're not a current member, we encourage you to become a member and support our work and our efforts in bringing presentations to you and then advocating on the national level as well as the local level. So with my 1-minute commercial there, I want to again thank everybody and welcome everybody to today's event, and really want to say a special thank you to Pilar for really putting the time into this to make this a really powerful event. It's one of the most powerful events I believe NCN has presented in many years. So with the I don't want to take too much of Pilar's time, but to those of you who don't know Pilar, Pilar Thomas is a partner of Quarles and Brady law firm. Her focus of practice is tribal renewable energy project development and finance, tribal economic development, federal Indian law, natural resource development, and she serves as the general counsel for Tribe Section 17 and tribal business entities. So again, I don't want to take any time away from Pilar. She's on a very tight schedule. We're going to end very quickly at 2 o'clock today. She has other events planned. So Pilar, I am going to turn it over to you, and I thank you for your presentation today.
Well, I thank you, and Happy New Year to everyone. For those of you joining us for this second webinar on models for Native CDFI participation in the State Small Business Credit Initiative. I know the webinar last week, we did a kind of a background on the SSBCI program. For this week, here's a just quick summary of me. For this week, we're just going to kind of refresh our memory on key program updates. We do have some new information since the last webinar. In fact, a quick summary of the programs, again, to refresh people's memory, and for those who are new joining us for this webinar, high-level policy guidance requirements, and then we're going to look at 2 additional models. Last week, we looked at 2 models, one where tribe is, the CDFI is a lender or a borrower in the SSBCI's Tribes SSBCI program, and a second model where they are the administrator of that program. And so this week, we're going to look at a hybrid model of participating as both a lender and an administrator. And then a 4th model around partnerships and CDFIs partnering with others to bring that leverage that's needed, that additional investment that's needed to the SSBCI program. And then a refresher on what the application requires and some model design considerations. So as a real quick, these links are live when you get this presentation. You can click on this, you can get access directly to the policy guidance that was issued on November 10th. That was updated by FAQs on December 15th. There haven't been any further updates on either the policy guidance or the FAQs. Treasury also, just before Thanksgiving, published the application form and instructions. So I encourage you to go into that and become familiar with what the type of information that Treasury is requiring the tribes to submit. And this is one of the opportunities CDFIs have to work directly with tribal governments around designing programs that incorporate CDFIs into that SSBCI program. The tribes got their initial allocation on November 10th, and then on January 8th, Treasury published the list of tribes that filed their NOIs. By my count, it's 395. I have to say approximately because I might have miscounted, but it's somewhere around 395 of the 574 federally recognized tribes filed NOIs. So what that means is everybody who's filed an NOI, the 395 tribes are all going to get more money. Treasury will recalculate and reallocate from the tribes who didn't apply, filed the NOI. They'll take those 200 or so tribes, 180 tribes, and they will take their money and they will reallocate it to the 395 tribes who did file the NOI. So everybody's going to get more money if you filed an NOI. Applications are due February 11th. If you don't file, if the tribe doesn't file the application by February 11th, they're not going to get money, even if they filed the NOI. So this 395 is going to be likely less, and then a reallocation will occur again. A quick summary of the programs. These are just very high level. Last week, we focused on participating in the loan guarantee program and a loan participation program. But certainly tribes can develop collateral support programs, venture capital programs. I haven't really covered VCPs because the rules changed pretty substantially for the venture capital programs from the last time to this time. But if you have any questions about venture capital programs, I'm happy to answer any questions you might have, but that hasn't really been the focus here for CDFIs. As we know, some of the attributes from the kind of the after action reports of how well loan support programs work focused on things like lending experience and underwriting infrastructure. Most tribes don't have that. This is where the CDFIs create a huge opportunity for tribes and working with tribes because of your lending experience, your underwriting infrastructure, having the appropriate loan terms for the base, for the customer base, for the borrower base. What's the right size? What's the proper use? What's the right rate? What's the right length? And working with tribes around designing loan terms, having sound underwriting standards, being flexible if it's a loan guarantee or a loan participation, being flexible in those percentages, or having a pretty standard percentage, making sure there's a qualified lender network. From 2010, that meant state or federally chartered banks, certified CDFIs, and credit unions. The rules have changed a little bit for tribes and tribal enterprises, in that tribal enterprises can be a qualified lender if they have sufficient lending experience. So that a tribal enterprise might be a part of the tribe's lending network. Who are we targeting? Is it a broad target or is it a very narrow and specific target of small business borrowers? Most tribes will likely want to target their tribal members or other small businesses located on or near tribal lands, but Treasury has allowed tribes to invest in small businesses just about anywhere. Tribal member business, no matter where it's located in the country, anywhere. Any small business, tribal or non-tribal, located on or near Indian lands or within the state that the tribe is located in. So if your tribe is in the state of South Dakota, you can make a small business loan to any small business anywhere in South Dakota. The tribe is not limited to tribal members only on the reservation. Now, some tribes may want to. So this is part of the program design of who the target is going to be. But then finally, there's got to be the ability to do compliance, data gathering, reporting, monitoring loan performance. And again, this is where CDFIs can lend their expertise to tribes. We talked about CDFIs as administrators through, for example, a direct loan program. This is what happened in the state of Washington, where the state basically just gave a portion of their money to a CDFI and said, you take this money, you match it with other money, yours and others, and you make direct loans with our dollars and your dollars. And so the CDFI put in its own funds, it attracted outside capital, and it made loans. Another model is what was followed in Georgia, where the CDFIs administered the program for the state in a loan participation program. So they went out and got other lenders, and they used the CDFI funds to make co-loans. So Bank of America makes a loan for $50,000. The CDFI makes another loan for $50,000. The borrower gets $100,000, and then the CDFI administers that co-loan. So there's some real benefits to both of these models. They've been followed before, and they are some ways for tribes to very easily employ the services of a CDFI to do a loan guarantee program or a direct loan program or a loan participation program. The CDFI, if they're serving as the administrator for a loan guarantee program, would be the underwriter for that loan guarantee. They would approve that loan guarantee. They can't do it for their own loans. So we're going to get to the hybrid in just a minute here. But it's important if we're thinking about this from an administration standpoint to remember what our responsibilities have to be as administrators. So we have to demonstrate operational skill, capacity, experience of our management team. We have to demonstrate the capacity to manage increases in volume. We have to have the internal accounting and the admin control systems. We have to be able to market the program to the eligible small businesses, and CDFIs are doing this anyway. Certainly within your investment area. Might have to work with the tribe around developing a qualified lender network. So in addition to the CDFI, are there other CDFIs that can be lenders? Are there other banks or credit unions? You might have to negotiate all these agreements. And the key thing is if you're serving in an administrative capacity, you have to comply, according to the guidance, with the tribe's conflict of interest rules and ethics policies. And the Treasury is very concerned about self-dealing and arm's length transactions. This was one of the biggest challenges they had the last time around, is they would turn money over to a third-party administrator, the state would, and then the third-party administrator would self-deal. They take a venture capital investment and invest it in their own business or in their relative's business. Or they might do a loan participation program with one of their own businesses. And so self-dealing and having a conflict of interest rules to prevent that, to ensure that from an ethics standpoint as well, that there's arm's length transactions occurring here. So these are going to be our key administrative responsibilities. All right, let's talk about the hybrid model. And I got this question last week and I said, oh, got to come to next week. So that's today. So how can a CDFI serve as both a lender and or borrower and an administrator? One key to wearing both these hats is the ability to have separate programs with separate accounting for those programs, not separate accounting systems, but to be able to account and track and report them separately. And in the case of the state of Washington, they actually created a separate entity. There's two reasons to do that. One is, of course, to separate so that there is sufficient, especially arm's length transactions, but really sufficient separation between the CDFI's participation in SSBCI as a, let's say as a lender, and then their participation in other other SSBCI programs as an administrator. So you might want to have consider a separate entity that would do that. One entity that's servicing, one entity, you keep the lending in one entity, you do the servicing in another entity. The other reason to do it is to segregate risk. And of course, that's what the state of Washington was most concerned about. The CDFI Craft 3 in Washington, they created a separate entity to segregate risk. There were some questions last week about whether the SSBCI money will be on or off balance sheet. If that's a concern, a separate entity might assist with segregating that risk. Another reason to look at a hybrid model is you're limited as a native CDFI. CDFIs are limited to their investment area. If you're a lender, you can only lend into your investment area. Even if you're a borrower and you go into a relending program, you can only relend into your investment area. But if the tribes are able to make loans or investments in their tribal member businesses, no matter where they're located, if your investment area is limited to the reservation, or let's say on or near the reservation, and your tribe has, or the tribe has tribal members on the other side of the state, then you can't lend to them, right? You've got that limitation. So one reason to do a hybrid model is it might be a solution to tribes' efforts to provide credit support for tribal members who live outside of the investment area. So if you're going to segregate by investment area, then one way to do this might be, for example, for small businesses that are located within your investment area, you participate as a lender borrower. So you maybe get a no interest loan from the tribe to relend directly to small businesses within the investment area. You might enroll loans in that case that are in a tribal administered. Maybe the tribe has another third-party administrator. So you would participate in the program that might be administered directly by the tribe or administered by a third party. So you would just be a standard lender in that circumstance, but you're participating because you're able to do these programs within your investment area. And then for small businesses outside of the CDFI investment area, then maybe you participate, maybe you're the administrator. So as an example, let's say the tribe has a loan participation program, and the program, however it's designed, whether it's a co-loan or a co-funded loan or a purchase loan. So the CDFI would, within your, as in this example, would participate in the investment area as a lender. And if the tribe is saying, sets it up so that within the reservation, the tribe says, we'll administer the program within the reservation. So you as a CDFI are just participating as any other lender might be. They might have you, they might have a credit union, they might have Bank of America, they might have Key Bank, whoever, the local bank, might all be lenders who are lending on the reservation in this loan participation program. But as we know, most tribal members don't live on the reservation. So most tribal members, small businesses, are not likely to be on or near the reservation. So if the tribe has a loan participation program, then they might have you, the CDFI, participate as a lender for on reservation within your investment area. But for off reservation or outside of your investment area, then the CDFI could serve as the administrator for that same loan participation program. So the CDFI would say to Bank of America, if you have a tribal member who comes in, I'm in Tucson, and let's say I've got a tribal member from my tribe who is located in Flagstaff. And so in Flagstaff, we get a couple of banks who say, yeah, we'll do loans with you for any tribal member who lives in the Flagstaff area. Well, the CDFI could then administer those off-reservation loan programs. And that's partly because the benefit here is that you might have a tribe who can maybe administer one type of program, but can't administer another type of program. I don't want to get it too complicated because there are opportunities. There's lots of moving parts here, but this is one way to ensure that tribal members, no matter where they live, are going to be serviced by the tribe or by a tribal administrator, and a CDFI who has the lending experience, the underwriting experience, and can actually administer these programs could serve as the administrator for all of the off-reservation or outside the state programs. Another way to split this up is by capability or capacity. Some tribes might have limited lending experience, or maybe they have a lot of lending experience. A lot of tribes run micro loan programs, so they might have limited lending experience. And so there might be one type of program where the tribe says, yeah, we can run that program ourselves, but we want to do these other two programs and we don't really know much about them. So CDFI, will you administer those other programs for us? We'll run one program, you run the other program. And again, you might participate as a lender in one of the programs and run the other two programs completely separately. And all that's based on capability and capacity. So you might have a circumstance where for certain loan support programs, the tribe cannot or doesn't want to be administered. They don't want to administer. So in that case, you would participate as the administrator. And then again, in other programs, the tribes might be able to meet the statutory considerations for administering. So you'll participate as a lender. In both of these circumstances, the key design issue is that the CDFI cannot participate as a lender and an administrator for the exact same program. So if you're administering the tribe's loan guarantee program, let's say it's off reservation, but you're the administrator for off reservation loan guarantee program. You cannot make a loan guarantee to yourself, right? It has to be into a completely separate lender. So that's going to be the conflict that has to be avoided. Key design issue. So I tried to draw a picture. I'm a lawyer. I should probably maybe had my marketing people do this for me, or maybe had Pete's marketing people do this for us. But I'm just trying to give you an example of how this might lay out. So tribe A, in this circumstance, I have two tribes because this model, you could do a multiple tribe model here. So tribe A, say that's the primary tribe, they get their SSBCI money, and they have a direct relationship with the native CDFI for purposes of lending. So native CDFI has a direct line to the small business borrowers. And then a portion of it goes to the native CDFI services company. So in this example, the CDFI has set up a separate entity. Doesn't have to be, but let's just call it, or a separate division, let's call it. But we separate the lending from the administration. That's what this box, the native CDFI box and the services box represents, the separation of lending from administration. So the tribe A sends money to the native CDFI to lend, or the native CDFI is participating in tribe A's lending programs, and then sends money to the services company to administer. The services company in this model is administering for separate lenders, right? Because you can't administer for your own lending, but you can administer for separate lenders. So lender A, B, C, and D. So depending on how big your ecosystem will be for the tribe, you might have one or two more lenders, you might have a bunch of lenders. And then those lenders in turn are running the tribe's SSBCI programs. It might be a loan guarantee, might be a loan participation, and those lenders are establishing the relationship with the borrowers. Now, in this model as well, you can have another tribe participate. So let's say you're in an area of the country where there aren't that many native CDFIs. Maybe there's one native CDFI for 10 tribes. And even though it's not your tribe, that's how many tribes are out there without a CDFI. So you have an opportunity to say to those other 10 tribes, tribe B plus, hey, we can administer your loan programs for you. We can also be a lender. If you want us to lend for you, if you have tribal members within our investment area, then we can lend to your tribal members within our investment area under your programs, and or we can administer some of your programs for you. And again, using the same lender network, assuming this is geographically concise, right? Or if one of these lenders is a national lender, a national bank who can lend anywhere in the country, or a national CDFI that can lend anywhere in the country. They might be one of these lenders, so you can cover tribal members in Chicago, Illinois as well. So I know it's not necessarily pretty, but let me pause there because that's the gist of the hybrid. And let me see, let me take some questions. First of all, can everybody see the presentation? I got a note that it's not sharing.
Pilar, I currently have it shared, so I'm going to stop sharing if you would like to share on your own.
Okay.
If that's okay.
Sure. Let me get back to it.
Okay.
There we go. Okay, so let me take this first question. What would administering consist of? So this is what we covered last week, and that was a couple of the slides that I laid out there. If you're going to administer a SSBCI program, you're going to have to be able to keep track of everything, account for everything. Depending on what the program is. So let's say it's a loan guarantee program. As the administrator, you would actually approve the loan guarantee. Bank A in this model here, or this model would be the administration model. So here's your administration native CDFI services company. Let's call that the administrator. And they're running loan guarantee and loan participation programs, let's say. So lender A gets a call from tribal member, small business borrower. They go to lender A and they say, I want a loan through the SSBCI program. Lender A is doing the loan guarantee, and let's say they're just doing the loan guarantee program. So lender A does their underwriting, then they send the loan guarantee request to the services company to approve the loan guarantee. That's administering it. So the CDFI services company approves the loan guarantee, tells lender A, we've approved the loan guarantee for X%, whatever the number is. Can't be more than 80% though, because lender A has to always have 20% at risk, at least 20%. So that happens. Native services company then has to keep track of that loan guarantee. They have to enroll, the term that's used by Treasury is enrolling the loan in the program. So they enroll the loan in the SSBCI program and they keep track of it. Now lender A has to send a bunch of information to the services company. Here's how many loans we made. Here's the performance of the loans. Here's who's paying. Here's who isn't paying. Here's how much money we lent. They have to provide information on the borrower because you have to keep track of, is it a tribal member business? Is it a small, a SETI, a socially and economically disadvantaged business? How much is the loan? What's the interest rate? Because you got to make sure all those loan terms comply with the loan program rules. So, and then you keep track of the loan. Lender A is going to service the loan. Borrower is going to pay lender A, just like any other regular loan. And when lender A calls you and says, hey, these people aren't paying me anymore, and they want to do a call on the guarantee, then you're going to follow whatever your process is that you've worked out to pay out on a default through the loan guarantee. So that's kind of administering at very high level, administering a loan guarantee program. Loan participation is a little bit differently. And then your responsibility back to the tribe is to say, here's how many loans we guaranteed. Here's how much money has been guaranteed. Tribal member businesses, other SETI businesses, there's other information Treasury wants. And so the service company on a monthly basis should be providing reports back to the tribe, because the tribe is ultimately responsible for reporting to Treasury. But this model is one where you have a tribe or multiple tribes who are basically leveraging a single CDFI to be both a borrower for some programs and an administrator for other programs, or to be a borrower only on the reservation and to be the administrator off the reservation, right? So you can slice that and dice that however you negotiate that with the tribe. But this would be an example of one way to structure a hybrid model of CDFI as lender and CDFI as administrator. Okay, let me take a look at another couple of quick questions.
And Pilar, we have
Yeah.
somebody with their hand raised.
Oh, okay.
Philomena, I'm sorry if I mispronounced your name. If you would like to turn on your microphone so you can ask your question.
Yeah, thank you. Can you hear me?
Yes.
Okay. So, you know, I've been trying to find some resources on how these arrangements can be structured in terms of a document, an agreement between a CDFI and our tribe. Treasury didn't have any materials whatsoever on this, and so I did look within their kind of best practices. There's a couple of states that do these programs where they offload the administration to a CDFI. I got a hold of Minnesota, and after a couple emails, they sent me the agreement that they have with the CDFIs, and it's structured like a loan. So I found that very interesting because I really didn't know where to start with you know, with the legal documents themselves. Is that what you see a lot of the times with you know, with the creation of these relationships, or you know, how else would it be structured in you know, legal terms with obligations back and forth and all that?
Yeah, there are a couple of different models. So in last week when we talked about CDFIs as borrowers, one of the reasons why some states lent their money to the CDFIs is because in their constitutions, a state constitution might have a no grant or a no gift policy in the Constitution. So the state can't actually give money to people. So in this circumstance, many states just quote unquote lent the money. So a CDFI, a tribe A, could lend the money to the native CDFI. In this model, this arrow could be a loan, could be a zero interest loan. And then the native CDFI then re-lends the money to the small business borrowers. So that's what some states did. They said, here, CDFI in Minnesota, we're going to lend you $1 million, and you in turn are going to turn around and re-lend that out. Tribes don't have those kind of limitations, so they can just grant the money, or they can enter into a regular contract and just say to, especially in administration, say to the CDFI, you're going to administer our program. Our money's going to sit here. It's not your money. Still our money. You're just administering it. So it could get a little complicated. There, obviously, we're free to construct agreements however we want to. There were three states that actually entered into service agreements with for-profit entities. I've got those contracts, those agreements. So lots of ways to structure that. The key model here is working with your tribe or tribes on what is the best way to structure it for your circumstances. And then we turn the lawyers loose to draft the agreements, right? You make the deal, then we write the agreement to satisfy your deal. But there are thankfully some models out there, and the states are able to share We've got models from Georgia, from Washington State, from New York, from Florida, from North Carolina. So we had lots of, there's no reinventing the wheel, thank God. All right, let me turn to question here. How much can they charge for admin charges? So this is part of the challenge, right? So you have a limit on your fees under the policy guidance of 2%. So if Tribe A sent you $1 million to administer their programs, and you then did a loan guarantee program, you could charge, let's say, a 2% loan guarantee fee, and that would cover hopefully your costs. But your fees on the loan program itself are partly what would cover your costs. Another way to cover your cost for admin, another way to cover your costs is if you were doing both lending and admin. The admin costs, you'd have to charge an admin charge, which would be a fee on the loan. Of course, as the lender, you're getting the interest of the loan. So that's where you're making your revenue as a lender. And that's why the hybrid model really creates two forms of revenue for you as well. Two revenue streams, an interest revenue stream on the loans, and then an administrative services fee on the services. Another opportunity that you have with the tribes is if they haven't per capped all their money out yet on their fiscal recovery fund money, they can use some of that money to support administrative services for small business lending. And we just got an update on the final rule from Treasury that clarifies that tribal governments, as well as state governments, can use their fiscal recovery funds for broader support for small businesses as part of the COVID recovery. So that might be a negotiation point for you and the tribe would be, we'll collect administration fees on the loans, but you also should pay us a little bit of money out of your fiscal recovery funds. Okay, hopefully that will help. Non-native CDFI, not affiliated, asked a partner, could one of these hybrid models work for us? Yes. Could you use a BIA guarantee program with any of these models? No, you can't. You cannot use any of the federal loan guarantee programs with the SSBCI guarantee program. So you can't use SBA, you can't use BIA, you can't use USDA. But if you're non-native CDFI, you can use this model as well. Okay, let me move on, and I'll take further questions in a little bit. I think I got to those. Let me talk a little bit about partnerships. So the reason why I think partnerships are important is because you've got to leverage your money, right? The rule is 1-to-1, minimum of 1-to-1, 10-to-1, and when you throw all the programs in. So if you're a relatively small CDFI and you don't have a lot of capital to lend, and the tribe says, I've got $1 million, and you say, well, I don't, then you got to go find another $1 million. So establishing partnerships is one way to bring that private investment that has to follow the SSBCI program investment. So partnerships will provide the opportunity to improve that leverage as the investment, since their investment will be the result of the SSBCI program. There are obviously multiple different types of partner considerations. These are where we saw the states partner with people in the past. Capital, going out and getting capital investors. So larger CDFIs who might already be investing in smaller CDFIs, other nonprofit foundations, and maybe even tribal enterprises who want to look at this as an investment opportunity for them, where they invest, and then you take all this money, you turn it into the one pot, right? The tribe's got $1 million coming in from SSBCI. You raise another $1 million. That's your loan fund. So now you're lending $2 million out. And so a tribal enterprise might be interested in investing in that loan fund as a way for it to make revenue for the tribe, or of course, other private investors. So that's one partnership consideration. Another one would be wrapping yourself with incubator or accelerator investors at the local, state, regional, or even national level. We hear a lot about tribal members who, maybe a loan is not enough. Maybe they're interested in an equity investment. Why? Because they don't have to repay an equity investment. I make a loan, I got to pay you every month. You make an equity investment in me, you let that ride for a certain period of time. Yeah, you're going to get a cut of the profits, but that's a heck of a lot more, not necessarily as regular as a loan payment is. So there are going to be circumstances where an equity investment might be more appealing to a small business. So working with incubator and accelerator investors is a way to bring equity investment to follow on with the CDFI loan program and creating kind of wraparound services. And then another kind of wraparound service would just be provide additional technical assistance and working with technical assistance providers. Some CDFIs do their own technical assistance. Others don't maybe have that capacity or capability. So you partner with somebody. It's a way for you to build capability and capacity. Might be a Chamber of Commerce, might be an NMDA. What's the minority? I get all my letters mixed up now. Other nonprofits or for-profits who are doing small business technical assistance, and you provide that as a value-added service, or you provide it as a service requirement. Right? How many CDFIs say to potential borrowers, I will only lend you money if you go through 6 months of training. So you have a similar opportunity here to partner with people. Now, the technical assistance could be paid for with the $500 million that Treasury has for technical assistance. So if that's a program that your tribe or tribes are interested in pursuing, this is another way to fund the technical assistance. Of course, the incubator program is funded by the investors, because they're getting their return through their equity investment. The TA program is going to be straight out of pocket. So a TA grant, or again, fiscal recovery funds can be used for technical assistance to small businesses. So that's another source of funding for that program. All right, let me see real quick what we've got. Let me just see if this question is, there are a few CDFIs that are skilled at servicing loans only. Is any CDFI seeking to partner to support servicing? Is any model developed to partner with tribes, seeking out tribes partner with a specific SSBCI model? Yeah, I mean, those are all good questions. Here's the thing to think about. Let me finish up the partnership and then I'll kind of summarize, because unfortunately I do have a hard stop. I apologize, Pete, that my day got completely jammed up on Tuesday. I talked about capital investors. You know, a smaller CDFI could use SSBCI funds to attract these outside investors. There are existing models, so we don't need to reinvent the wheel. I'll point to Washington again, Craft 3. That's what they did. They went out, they put their own money in. They went out and got outside investors, including some foundations, to put money in. The key here too, of course, is that it reduces the amount of CDFI capital that you have at risk. So if you've only got, $1 million cushion and the tribe's got $1 million, you don't want to put your whole cushion at risk, right? So by attracting outside investors, you're minimizing your risk, but your capital grows, right? Through the loan programs that you run, and especially around for SSBCI purposes. And then of course you size the amount of investment you need based on either what you know the loan demand is going to be or what you expect the loan demand to be. So you don't have to try and go raise $10 million for the $1 million. You only need $1 million for the $1 million, a minimum. And then as you keep relending money, that keeps adding to your I should say, to the tribe's leverage. So if I can turn those loans around quickly, relatively quickly, every time I relend, that counts towards my leverage. So it's another way to attract outside, create more leverage, reduce the risk to you, but keep building that outside leverage. Craft 3 is the great example here. They attracted enough outside capital that they immediately had a 5-to-1 leverage ratio. So that's one way to build that up fast. Incubator accelerator partners, incubator accelerator programs, right, are additional development services for tribal businesses who might need assistance to qualify for a loan or an investment. It's an alternative option. So as I said earlier, they could get a loan from the CDFI and or an equity investment from the accelerator partner, investment partner. And it expands the reach of your SSBCI programs, especially beyond the CDFI investment area. So if you're administering the program for a tribe and you're administering it beyond your investment area, now you've got multiple programs you can offer to tribal members. And if you're making partnerships with accelerator programs in, Illinois, or take a look to see where your tribal members are in the city of Phoenix, then you're expanding your reach, you're helping the tribe expand its reach, and therefore you're creating more opportunity for the SSBCI program to work. Remember, SSBCI, I told Pete I was going to work my little joke in one way or the other. SSBCI money is like manure. It only works if you spread it around. Okay, TA, we already know what this is. I've talked about it's a value add. It can be funded by ARPA, fiscal recovery, and the TA grant. You can leverage your small business networks, and ideally it's improving qualifications for small business borrowers and investees. So what are some of the key next steps? I'll just repeat this from last week as well. One of the key opportunities the CDFIs have is to create a model program for the tribes. The tribes still have to fill out this application on February 11th. They still have to write this stuff in and push that send button. They don't know. They don't know. Some tribes know, most tribes don't know what this program should look like. So if you're working with your tribe, and this is, we're a little bit backwards here than the last time. A lot of states ended up working very closely with their lenders, with their CDFIs to design programs. This is, for the state. And so there's a same opportunity here to work with your tribe or to propose a model program design. You know your borrowers, you know your market, you know what kind of loans are going to work. You know what kind of loan terms are going to work. You know whether a loan guarantee program versus a loan participation program makes the most sense. And so to the extent that your tribe is listening to you or wanting to work with you, the key opportunity here is to design the program for them and say, here's the program we'll run. We'll run it for you. Here it is. And then they just copy and paste it into their application. The key as well is there's a lot of other information the tribes have to gather. What's the benefit? What's our leverage calculation? How many jobs are we going to create? How many loans are we going to create? They're not going to be able to do that if you're an active CDFI in their area without getting that from you. You're making these loans today. Of course, if you want to administer with the tribe, you got to start up administration discussions. In the application, there is a section that the tribe has to put in for each program if they're going to have a separate entity contracting to administer that program. So, and I know it's in a ideal world, but in a very simple process way, CDFI drafts a design model program, says here's a loan guarantee program or a loan participation program. Tribe Put this in your application, we'll administer it for you. So put us in as your contracting entity. And so, and that's all they have to do by February 11th. We don't have to have any agreements in place. We don't have to have any of this stuff in place. We just need to say, here's what we're going to do, and here's who we're going to do it with. So at a minimum, if we can get past this February 11th, we can get yes from Treasury and start getting our money. We can start making changes if we need to. We're not bound by what we say on February 11th. We can add, we can change, we can delete. So the tribe gets its money, they send you the money, and you find the loan guarantee program, nobody's interested. Nobody wants to do it. Okay, fine, let's do this. Let's do the loan participation program then. And then you submit new information on the application to do that. So lots of opportunities to change also what you need to do. If you are going to administer, if you've already engaged in those conversations with the tribe and you're working with the tribe, we've got to find some other lenders out there. Who's actually going to be making the loan? Who are our partners? Are there other CDFIs? Are there other banks or credit unions in the area? Does the tribe have any enterprises that want to participate? And then you call the lawyers and you start negotiating agreements. So with that, let me check the last little bit of questions. If a CDFI is the administrator, can the agreement between the tribe and the CDFI allow the CDFI to keep the funds as a grant when the program is over? Yes, and that's in fact what happened in Washington and in Georgia, where the CDFIs were the administrators of those programs. And so when the program was over after 10 years or 7 years, whatever it was, then they wrote in that the CDFI could keep the money. Alternatively, and it went in as unrestricted capital to the CDFI. Alternatively, other states that did loans to their CDFIs, whether they were zero interest or low interest loans, they also wrote in that in effect that loan would be forgiven. So the CDFI, let's say the tribe lends you $1 million and says, go out and re-lend this. You still got to come up with $1 million. So you go out and you re-lend the $1 million, but it's a loan to the state or to the tribe. The tribe says, we're going to lend it to you, zero interest, so you don't have to pay us any money. You re-lend it. And at the end of 7 years, you get to keep the money. And, you know, hopefully everybody's paid you back. But some states said, no, you got to send the money back to us. So that's going to be part of your negotiation. The tribe might say, yeah, we'll lend you $1 million and you can make revenue on it because you're re-lending it. You're going to make interest income. But at the end of 10 years, send us our $1 million back. So you're going to have to negotiate that with the tribe. Okay, with that, do I have anything left? The applications are due the 11th. Tribe, if approved, the tribe has to, this is the process. They have to sign an allocation agreement. They will get the first tranche, 33%. They have 3 years to spend 80% of that 33%. So sometime we can amend, we can add, we can delete. We just have to send new information to Treasury for approval. So we're not stuck. We're not stuck. All right, with that, Pete, happy to take any final questions before I have to bump.
Yeah, I would like to encourage anyone that has any final questions. We have about 4 minutes here. If you have a question for Pilar, please type it in the chat if you can, or if you have a quick question for her, we can ask her now. We're going to again send all the questions to Pilar. And then the other thing is in the next week or so, I suppose, Pilar will have the white paper finished.
Yeah.
Yep.
We'll have a white paper that will address in a little bit more detail some of the questions, because I know I answered them pretty quickly in some circumstances. And so we'll have all of this information, a lot more detail with some examples of models that were used before. This hybrid model it was used in a couple of places. And of course, as usual, the devil's in the details. Let me answer real quick this question about being able to use the money for a revolving loan fund for construction loans. The answer to that is no. These loans have to be used for small businesses. So if you have a program with you, if the CDFI gets money from the tribe and it's going to relend that money, you can only relend it to small businesses. So you can relend it to a construction company that's building homes on trust lands, but you can't relend it to a homeowner for a mortgage. So you're lending, the purpose of your loan, they're not making a loan to you as a small business under the program. They're making a loan for you to relend to other small businesses. So you will be limited in a relending environment on who you can relend to. Let me see if there's one last question. Can a tribe hire a CDFI for lending administration who will then lend to small tribally owned businesses, or is this a conflict of interest? So the tribe can hire a CDFI as a lender, and they can hire to administer programs, but the CDFI cannot administer the same program that it's the lender for, if that makes sense. So that's why, for example, if you have other lenders, the CDFI can serve as an administrator for other lenders, for Bank of America, for the credit union, for another CDFI, but it cannot serve as an administrator for its own loan programs that it's participating in. Someone else is going to be administering that program. It might be the tribe or it might be another administrator. Hopefully that answered that. Will you have documents that Native CIs can use to have tribes sign? Can you lend to tribe charters that tribe owns? Yes. So will I have documents CFIs can use to have the tribe sign? You mean agreements? Well, you'd have to hire me to draft your administration agreement. So there are various models of administration agreement. I think that's mostly the subject of negotiation between the CDFI and the tribe. I'm happy to work with Pete on potentially developing some model agreements for your guys' consideration. We can talk about that offline, Pete.
Yep.
Then can you lend to tribal charters that the tribe owns? The CDFI can lend to a tribal enterprise. So if tribe A makes money in my model, you have the CDFI as the lender. If the tribal small business borrower is a tribal enterprise, then the answer to that is yes. A CDFI can lend money to a tribal enterprise using SSBCI money and the CDFI's own money. The tribe cannot lend, as near as I can tell, the tribe itself cannot lend money directly to its enterprise unless the tribe has experience in already doing that. Well, the tribal administration issues are, beyond the scope of this webinar. So for purposes of the CDFI, the answer is yes, a CDFI can lend money to another tribally chartered enterprise. Can it lend money to an enterprise that it owns? No, because that's going to be a conflict of interest. You cannot make a loan to yourself, in other words, using the SSBCI money. Just like you can't make an investment in yourself using the SSBCI money. Okay. So let me unfortunately, I have to jump. I'm happy to answer any questions I didn't answer. NCN is going to send me the chat box. So I will get back. I assume we've got everybody's contact information, Pete and Kirsten. So I will get back to you if I didn't get a chance to answer it. I apologize. In our last week, we had a little bit more time. This week, so I'm a little bit more crunched for time. And as Pete mentioned, on behalf of NCN, I'm drafting a white paper that will cover all of these models. in a little bit more detail, and the questions have been very helpful for scenarios. And so I will also respond to many of these questions by answering them in the white paper. So, so look for that if you're a member, as Pete said. And Pete, are there anything else you need me to say to everybody before I hit the leave button?
No, I thank you, Pilar. And like you said, if anyone wants Pilar services outside of this presentation, please contact her. She's wonderful. She knows what she's talking about. So please give her a call if you want to engage her services further. And the only other thing, Pilar, is I want to, if you have to jump off, everybody will say our goodbyes to you, but I just want to guide everybody to where the videos are located on our website.
All right. Thank you, everybody. Thank you, Pete. Everybody have a safe and happy new year.
You too. Thank you.
Thank you.
Okay, Kirsten, if you go to, for the videos there, we've had some questions. Where are they located at? You want to scroll down there, Kirsten, to the SSBCI? There we go. And then you just click on the news, scroll down, and you'll see there's the video of our first session. And then we'll have up there today our second session as well. And the white paper, again, is going to be available for NCN members. So I encourage everybody to become an NCN member in some capacity. And the questions that everybody's following up with here, we will make sure Pilar gets them in there. She's going to address a lot of these in her white paper. So please stay tuned. And as this develops here next week, or at the end of this week, I'm going to have a conversation with Pilar and we'll see what our next steps are, how we can help CDFIs. So I want to thank you and keep tuned to NCN, and we'll let you know what's happening with Pilar.